taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. Traditional IRAs, Roth IRAs. What is that? Welcome back to our What is That series, where we break down financial terms just for you. We're talking financial vehicles, and these are some of the most important financial vehicles on your road to worry-free financial retirement. So let's start right at the beginning. IRA stands for Individual Retirement Account, and it was put into legislation in 1974. The traditional IRA allows you to contribute pre-tax income dollars. You essentially take a tax deduction in the current year for having made a contribution to this account. Your tax dollars grow tax deferred. So how exactly does this money grow? Well, you put the money into a brokerage account like Vanguard or Charles Schwab, and you then invest that money into things like stocks, ETFs, mutual funds, and those assets grow. Although these funds are invested in the stock market, the IRS does not impose capital gains or dividend taxes until you withdraw that money. The advantage of having an account like this is that when you eventually withdraw the money, you're in retirement. You have a very low tax bracket because you're making a lot less than you were in your working years. Potential drawbacks for someone investing in a traditional IRA is the early penalty withdrawal. This is a 10% tax penalty that you pay in addition to income taxes. The reason why this penalty exists is because you're attempting to withdraw from a retirement account before you've retired. So the IRS wants to incentivize you not to do that. They want you to use this account for the purpose that it is, which is in retirement. When we discuss traditional IRAs, it's very important for me to mention that if you have access to a 401k with your employer, then you may not qualify for a deduction of contributing to a traditional IRA. You want to be very careful about contributing to additional retirement accounts when you already have access to retirement accounts with your employer. Roth IRAs. What is that? The Roth Individual Retirement Account came into legislation 23 years after the traditional IRA. It came into legislation in 1997. They are almost essentially the same thing, except for the way they are taxed. Roth IRAs are funded with after-tax dollars. That means in the year you make a contribution to it, you do not get a tax deduction. The benefit of this account, however, is that your tax dollars grow tax-free. That is, all the earnings that you make in this account over time, when you finally withdraw it in retirement, you have no tax liability. Things happen and you might need to withdraw from your Roth IRA. Your Roth IRA allows you to withdraw only your contributions back as tax-free because you received no tax deduction when you initially contributed it. However, you cannot withdraw the earnings on that contribution tax-free. With the traditional, we discussed that if you withdraw early, you have a 10% penalty and income taxes. However, with the Roth, you can actually withdraw the contributions you made and have no tax implication. However, you cannot withdraw the earnings on that contribution. Those are still subject to penalties and tax. There is another drawback surrounding the Roth IRA, and it's related to how much income you make. If you're a single individual in 2020 who is making more than $139,000, you actually can't contribute to a Roth. There's been so many times where I've talked to clients and told them that they have to now withdraw the contribution they made because it wasn't legal. So it's so important that you speak to your accountant before you make any kind of IRA, whether traditional or Roth contributions. There is a loophole for those individuals that make too much to contribute to a Roth IRA, and it's called a backdoor IRA. It's a very complex strategy, so I highly recommend that you speak to me, your accountant, before doing something like that. Individual retirement accounts have a contribution limit every year. In 2020, that limit is $6,000 if you are under 50 years old. If you're over 50 years old, that contribution limit is $7,000. It's very important to note that these limits are a max total limit, which means you cannot contribute $6,000 to your traditional and $6,000 to your Roth. It's $6,000 total between the two. My retirement advice is usually always the same. Think about how you want to live in retirement and then work backwards. If you want to travel, if you want to live your best life, Social Security is not going to do it for you. So it's so important that you start aggressively saving towards your retirement accounts now. It is never too early to begin. So which one's my favorite? Personally, I love the Roth IRA. I personally believe that income tax rates will go up in the future. Also, when you inherit a Roth IRA, there are so many benefits for the beneficiary. So it's great to be able to know that you're gonna leave tax-free income to your future inheritors. With that said, a traditional IRA might still be a good strategy in the current year, and you can always convert a traditional IRA to a Roth IRA in a future year. There are so many different strategies available to you, and that's why it's so important that you have a great CPA on your side helping you with your retirement financial goals. We hope you enjoyed this latest installment to our What Is That series. Please like this video, subscribe to our YouTube channel, follow us on LinkedIn, Instagram, or Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.